return on capital employed. This ratio has two parts, return and capital employed. By return, we normally mean profit, and capital employed is the money which is invested to generate that profit. There are two types of capital employed in the business: long-term capital and working capital. Long-term capital comes from two sources. One is shareholders' money, owners' money, and the second is debt, loans, borrowings. With this long-term capital, what we do, or long-term capital employed, what we do, we establish our business and we invest that money into the assets which will create products, which will create services, and hence we will sell those and then we will make profit out of it. So this ratio assesses how much money we invested in our assets and how much return they are creating. The other type of the capital is called working capital, which is used to run our business on daily basis, pay for wages and bills, etc. And usually that money comes from short-term loans or bank overdraft or the spare money which we generate during our sales and purchasing cycle. So this money does not come usually from, and ideally should not come from, our long-term capital. Long-term capital should only be invested in the long-term assets, non-current assets. So what we do, we assess different companies, one company with the other, that if they invest £100 in their long-term assets, how much return they're creating in comparison to the other companies, which help us to understand which company is using their capital employed better. The process of ratios requires us to look at the formula, understand which figures needed for that formula, locating those figures from the financial statements, and then using those in the formula. And that's what we will do in this class. ROCE, return on capital employed. We need operating profit, a figure which can be found in income statement, share capital and reserves, and the long-term loans can be found in the balance sheet. So let's go and look for operating profit. This figure is given clearly in the income statement, 156.5 and 253.2. That's my operating profit. It is also called profit before interest and tax. So your company may use that wording for this bit. The second bit is share capital and reserves. So that will be found in balance sheet, our statement of financial position. The very last segment or area of balance sheet is equity area. If you read the first line, it says share capital, and then the rest of these things are all called reserves. So when it says share capital and reserves, that means equity. We need to pick the total equity figure and place it in our formula. The next is long-term loans, which can be found in the balance sheet. So non-current liabilities, long-term mean non-current, okay? So not all non-current liabilities are loans. You need to find which one is loan. And if you go through this, you can see borrowings and other financial liabilities. That's the figure which we are looking for. So we'll copy this onto our workings. Let's take a simple example. I take a loan from the bank for 5 years. I need to pay it within 5 years. 5 years loan, £50,000. So when I take the loan, I record the transaction as non-current liability. That's my loan, that's my borrowings. But when I present this information in my financial statements, I am required to segregate the part which is to be paid within the next 12 months and the one which will be paid after those 12 months. because my loan is for 5 years. As soon as I take a loan, in the next 12 months, I have to pay back £10,000 back to the bank. So when I present that loan in my financial statements, I will present 40,000 as non-current, long-term, and 10,000 as my current loan, current liability. What we need to understand that what type of capital employed is that? And at the start, I explained the purpose of the long-term capital employed. It is invested in the business assets. That 50,000, the essence is that there was a capital employed long-term, so it should be included in the calculation. Otherwise, if you remove it, our ROCE will be higher, artificially higher, incorrectly higher. So that's why. Not many companies has this issue, but some still has because it's a legit issue. Sometimes what happens, the loans which company takes, they're not paid back. They take a loan for 10 years, so they will have to repay at the end of that 10 per year. But what happens at the end of 10 years, that loan gets rolled back. So keep the money forever. So this issue, it doesn't apply to most of the companies, but then some companies do have this issue. So what we do, we pick up this figure as well and add it 125.6 and 518. So this is the complicated area. For some companies, there are no loans. I think Burberry is an example. They don't have any borrowings, no loans. So they will have simply operating profit divided by equity, job done. And that ratio is also called return on equity rather than ROCE. But if they don't have borrowings, then ROCE and ROE are the same things. Okay? So sometimes it will be simpler, sometimes it will be a bit more complicated. Is it good or bad? No idea, because we have no comparison. So there are two types of comparison could be done in ratio analysis. One with the company's own historical data, which is called horizontal analysis, and the competitors' data, which is called comparative analysis. So for your coursework, you should do both. You're explaining ROCE. First thing, steal the definition from one of the accounting book, okay? So to do that, grab 3-4 books from the library, go down the ratio analysis chapter, write down those books word to word, reference them properly, insert them into your workbook. That's your start. That one thing you can do without any thinking. Simply copy and paste. Then what you need to do, you need to explain your results. Simply state that the ROCE has increased or decreased from 2020 to 2022 by this much. That's another sentence, so that's 2 sentences. Then what you need to do, tell me that increase or decrease is a good thing or a bad thing. So for profitability ratios, when the results increase, that means good thing. So you tell me that the ROCE has increased, which means the performance of the company in this area has improved, or if it's consistent, or it has decreased. These 3 things you state, you will pass the coursework, or at least the financial analysis part. To do more, to get more marks, then you will compare the results with the competitors' data, and you will find out the a reason for a decline, and then you will link it with what is happening now. 7 features of ratio analysis. There's a video on that.